In this video, we're going to be looking at basic transactions when money is going out of the business when GST is involved. Looking at this first transaction here, on September 1, we paid electricity for $550 GST inclusive. So firstly, we need to think about the accounts involved here. We paid electricity, so we know cash at bank is going to be one account involved. We paid electricity. So electricity, which is an expense, is going to be another account involved. The final account involved is going to be our GST account. Now, because we're paying an amount, the GST account that is going to be affected is GST credits received. Now, this is a special type of account. It's actually a negative liability because we're going to receive a credit from the government for paying this GST component. So what I'm going to do firstly is add down here another type of account. So I'm going to call this a negative liability. By nature, negative liabilities are actually debits. So you can see here liabilities normally are credits. It's basically the opposite. Negative liabilities are debits. If they increase, they stay as a debit. If they decrease, it changes to a credit. Okay, we're now ready to fill out this transaction table. So on September 1, the first account affected was cash at bank. The second account we identified was electricity, and the final account we identified was GST credits received. Okay, firstly, our cash at bank. So we've paid $550. So cash at bank is an asset by nature, that's debit. We've paid an amount, so it's decreased. So that's going to change around to a credit of $550. The electricity account, so we know electricity is an expense. Expenses are debit by nature. So electricity is an expense account, which is a debit by nature. Our expense account has now gone up, so it stays a debit. Now in this entry here, we put the ex-GST amount. So that's going to be $500, the ex-GST amount. GST credits received, so that's a negative liability account, a negative liability. By nature, that's a DR. It hasn't, it's increased, so it's going to stay, increase here, it's going to stay a DR for the GST component, which is $50. You can see here, our two debits equal our credit. Let's look at this next transaction. On September 2, we purchased stock for $1,100, GST inclusive, paying cash. It's sometimes a good idea to split up this amount into its GST components. So 1,100 divided by 11 is $100. That is the GST component. We will then know that the ex-GST component is 1,100 minus 100. So $1,000 is going to be our ex-GST amount. Okay, let's think about the accounts affected now. So we purchased stock. Now stock, another word for stock is inventories, and that's actually an asset account. The other account affected is going to be cash at bank, and then our GST account as well. So September 2, the accounts affected, we have cash at bank, stock or inventories, and our GST account, which is our GST credits received, because we are paying an amount, so we're going to get a credit for that. GST credits received. There are three accounts involved. Cash at bank we know is an asset. By nature, assets are debits. We've made a purchase, so our bank account's going to go down. That's going to change to a credit for the total amount of $1,100. Our stock or inventory account again is an asset account, which is debit by nature. It's gone up this time, so it's going to stay a debit for the ex-GST amount, which we figured out was $1,000. Our GST credits received, the type of account that is, that's a negative liability. Remember down here we created a negative liability account. Negative liabilities by nature are debits. It's going to increase, it's going to stay a debit for $100. This transaction here is a little bit tricky. September 3, we purchased a computer, which is an asset, on credit for $3,000 ex GST from Computer Supplies. So the key here is that ex GST little amount here of $3,000. So that's actually a trick. So we need to figure out the total price or the GST component of that. So when we're given an ex GST amount, to find the GST component, we divide by 10, not 11. So 3,000 divided by 10, we know is $300. Therefore, the total amount for this computer, total, that we'd have to pay is $3,300. So just be careful with this transaction. There's a little trick in there. All right. What I'll get you to do is pause this now and try to figure out this transaction for yourself, and then press play and check you're working. So on September 3, the accounts affected, we purchased a computer. So our first account is a computer account, which is an asset account. How did we pay for this? We didn't pay for it with cash. We paid for it with credit. So that's going to be accounts payable. And then our final account is our GST account. GST credits received. Computer is an asset account, which is a debit by nature. It's increasing. It's going to stay a debit for the ex GST price of $3,000. Accounts payable is a liability account. Liability accounts are credit by nature. Our liability account has gone up. So this is going to stay a credit for the total amount. So we owe Computer Supplies $3,300. GST credits received is a negative liability. Negative liability, remember we created earlier, is debit by nature. It's gone up. It's going to stay a debit for the GST component, which is $300. You can see here our two debits equal our credit.